The Wall Street crash of 1929 was perhaps the most severe American stock market crash of all time. The crash is commonly thought to have spanned from September to late October of 1929, at which point the New York Stock Exchange share prices collapsed. In the first half of the Roaring Twenties, companies had much success in exporting to Europe, which was rebuilding from World War One. Unemployment was very low, and the automobile industry grew rapidly in strength, creating jobs and boosting the economy. In the 1920s, investing in the stock market became somewhat of a hobby across the whole nation for anyone that could afford it. Even if money was a problem, these people could borrow from stockbrokers to finance their investments. Many people were buying stocks on the margin, which is where the buyer pays only a percentage of the asset's value and borrows the rest from a bank or a broker. However, people were not buying stocks on fundamentals. Instead, they anticipated rising share prices. Everyone was convinced that the stock market was an easy moneymaker. In mid-1929, the economy stumbled due to an excess in production in many industries, creating an oversupply. Essentially, companies could acquire money cheaply due to high share prices and invest their own production with the requisite optimism. This overproduction eventually led to oversupply in many areas of the market, such as farm crops, steel, and iron. Companies were forced to dump their products at a loss, and share prices soon began to fall. Margin trading can lead to significant gains in bull markets, since the borrowed funds allowed investors to buy more stock than they could otherwise afford just by using cash. As a result, when stock prices are rising, the gains are increased massively. However, in the case of falling markets, the losses in the stock positions can also increase. When the stock market crashed in 1929, banks issued margin calls. This is when a portfolio loses value too quickly and is required to deposit more money in order to cover the decreasing value. As a result, the stock market spiraled downwards. Many investors were completely wiped out, and Americans began withdrawing their cash from banks, while the banks, which gave out excessive numbers of bad loans, were left with significant losses. So the crash itself began on October the 24th of 1929 and was known as Black Thursday, when the market opened at 11% lower than the previous day's close. Institutions and financiers stepped in with bids above the market price to try and stem the panic, and the losses on that day were modest, with stocks bouncing back over the next 2 days. However, the situation soon worsened in the following week, with Black Monday and Black Tuesday resulting in a further 23% market drop. The impact of the crash saw many investors completely wiped out, from professional stockbrokers to small businesses and families, with many people forced to sell their belongings in order to pay back loans. Now, there were attempts to revive the stock market during the crash. On October 24th, several key figures within the banking sector, those being the head of Chase National Bank, the head of Morgan Bank, and the head of National City Bank of New York, came together in order to discuss the matter. They handed a large pool of money over to Richard Whitney, who was the vice president of the New York Stock Exchange. This was then used to buy shares in various stocks of major companies and assets, including US Steel. While this temporarily steadied the market, as discussed, Black Monday and Tuesday saw further losses, which further sent the stock market on a downward spiral. Now, whilst this video is not necessarily about the Great Depression, it is worth mentioning one thing. It is important to remember that the crash and the depression are not the same event. The stock market was and is not the same thing as the economy. Though one cannot deny that the crash removed much confidence in the market and thus undoubtedly contributed to the Great Depression. To summarize the crash itself, by October 29th of 1929, the Dow Jones Industrial Average had dropped by a whopping 30.57%, marking one of the worst declines in US history. So that's it. Thank you for watching this brief explanation of the 1929 stock market crash, and be sure to subscribe for more history content just like this.